Welcome back to the Market Maker Mastery 2025 and the second episode of the series. If you want to know how the markets really work beyond mainstream knowledge, then you've come to the right place, because in this series I'll show you step by step how to understand the mechanics of the market and use them to your advantage. No secret groups, no fake signal services, just real analysis and real results. Today we are diving into a topic that causes many traders headaches and yet hardly anyone explains properly, namely the interplay of timeframes in trading, often referred as timeframe alignment, because that is the basis for how you view the markets. If you've ever thought, why is this a downtrend here but everything is bullish on the higher chart, then this video is made for you. I promise you that if you really understand this episode, your entire understanding of the market will change. Today we are talking about a concept that will help you bring order into the chaos, combine timeframes intelligently, make clear decisions, and above all, avoid many mistakes. Because if you combine timeframes incorrectly, you often end up working against yourself without even realizing it. And the result is often no plan, no direction, and no profits. But if you understand this theory correctly, you will see the markets with new clarity. So be sure to stay tuned until the end, because this is the foundation on which every successful trading approach is based on. Why timeframes are the starting point of every analysis? Let's start at the very beginning. When you open a chart, what is the first thing you do? You probably look at the price history and then click on different timeframes. 15 minutes, an hourly chart, a daily chart, maybe even a 4-hour or weekly chart. And what happens then? Exactly. You get different pictures of the same market. Sometimes it looks bullish, sometimes bearish, sometimes sideways. And that's exactly the point. Each time frame tells its own story, which is why it's so important to understand that time frames are not a gimmick, they are your foundation. And if you combine them incorrectly, then your entire setup is on a shaky ground. So when you open the chart, you see different movements depending on the time frame. But from what perspective? If we are looking at the weekly chart here, for example, and refer to the last video in the series, we see that liquidity in the form of buy stops has been taken out of the market. Accordingly, we also saw this reaction here. But let's now take a look at a lower time frame. Here, for example, we can see on the daily chart that we have already compensated for this inefficiency and that the market is reacting to it again. If we now go down to the 4-hour chart, we see a somewhat reversed picture again and see that highs in the form of buy stops have already been taken out of the market. If we go down another time unit, we now see that buy stops have been taken out of the market and we still have an inefficiency above us in the market. This again means that in the short term, we can expect bullish movement. Now, how can we combine all of this when we move down from the weekly chart? We see that we have first swept buy stops on the weekly chart, but here too, this inefficiency has been filled again. So if we briefly mark this fair value gap, this inefficiency on the weekly chart, we see that we cannot read too much from it at the moment. In the daily chart, we see again, okay, buy stops were recently removed from the market here. This means that the last reference point in the chart is always the decisive one for us. We have filled this inefficiency, but have already entered a liquidity pool again. We can see this better here on the 4-hour chart. We marked it here beforehand because several identical highs were reached. On the hourly chart, we could now identify targets and inefficiencies. This raises the question, how far can price go? Well, if we look at the whole picture here, we see that we have a low and a fair value gap below it, but also a fair value gap above us. This means that we must allow the market to close this inefficiency first before we can expect a short. And that's exactly what trading in timeframe alignment is all about. Waiting until all timeframes point in one direction. At the moment, the hourly chart looks as if this inefficiency will still be reached. And only when that is the case, and we observe a reaction here and see how exactly this inefficiency is closed again, only then can we start looking for the direction of the higher time frame setup. And here too, we see how the market then takes reference points in the smaller time frame into account. We see that the fair value gaps are respected here. If the price also fits the higher time frame, here it was slightly overshot, but the closing price respected it and the price continues to fall. The next one was also respected here, and so on and so forth. And we see that all these inefficiencies are at least partially targeted again, and the market moves toward its final target based on all our time frames. So let's briefly explain the basic principle. Relativity in trading or time frame alignment means that all time frames must point in the same direction. Market structure, order flow, candle patterns, everything is basically dependent on the time frame. If you only look at one time unit, you get a highly distorted view. You have to learn to consciously combine time frames. If you want to delve deeper into the subject matter, I'll also link to our free trader workshop below the video. But everything you learn here is based on understanding the smart money perspective. That means the big institutions that move the markets and how we traders can use that to our advantage. Okay, time for structure. There is a clear hierarchy in the market. If we understand our trading as a business, we can also apply this metaphor to the time frames. The monthly chart, so to speak, is the CEO. The weekly chart is the management and the daily chart is the team leader. So these three time frames are essential for our overall picture. After that, we can go ahead and look at the 4-hour or the 50-minute chart depending on whether we are swing traders or day traders in the market to look for our entry setups. But only after the CEO, so to speak, the management and the team leader tell us which direction to go. Of course, there are also time frames below, such as the 5-minute chart, the 1-minute or even second charts. But this is where it gets a little bit critical, because we not only have to operate profitably in the market over the long term, we also have to consider the costs of the business. And on the 5-minute chart and below, on certain markets, this is the breaking point where costs often rise immeasurably. So if you're even trading on the minute chart or second chart in the Forex market, the trade costs amount to 10, 20 or even 30% of the risk. This means that it's not even enough to simply trade consistently profitably on these time units. You have to make an additional 20 or 40% over the year in order to even cover the costs. This means that when you are starting, I would focus on the left side, so definitely at the 15-minute chart and above. And you will see that even on the 15-minute chart, there are excellent day trading setups available. So to clarify this a little, if the CEO and the management say we are going to Rome, our employees here on the left should not just go to Paris, because otherwise they will be fighting a losing battle. Similarly, if the boss now says, okay, we're going to Paris, management wants to go to Rome, and the team leader says, but Madrid is nicer, then we see that this market is perhaps simply not suitable for trading at the moment. What does this mean? If the monthly chart is pointing up, the weekly chart is pointing down, and the daily chart is in a sideways movement, then perhaps the best thing we can do as traders is to simply sit tight and look at another market. However, if everyone agrees, both the executive board and the management and also the team leader say, okay, it's going in one direction, it's going up, all time frames are pointing upwards, then we can look for long setups and buying opportunities here in our entry time frame. So each of these three time frames has its own role in the analysis process, so to speak. The 3-step plan for our analysis: to avoid wandering blindly through the chart, you need a clear plan. And here it is. First, we need a bias, a direction in the market. This happens on the higher time frame. That means on the monthly and or weekly chart, we are predominantly long, so bullish, or short, i.e. bearish. In our trading process, we always support this by our fundamental valuations, and based on that, the reference points where the price is likely to go next. Now, how can we very easily evaluate a market fundamentally? We will be covering that in another video in this series. So be sure to subscribe to the channel and activate the bell so you don't miss any future videos in this series. If we are fundamentally bullish or bearish, then we have to look at, okay, where is there an overall target in the market? Where is there a reference point, a liquidity pool, a magnet for price, so to speak, and that's explained in episode 1 of the Market Maker Mastery 2025. Point number 2 is the target zone. This is determined on the daily chart or on the 4-hour chart, depending on whether you are a swing trader or a day trader. It may also be the hourly chart. However, it is important to note that we may simply have to wait and see. If not all timeframes are pointing in the same direction, it is also our job as traders to refrain from placing a trade. On the other hand, if we identify an entry point, an inefficiency, or a liquidity pool on the smaller time frame, as it is the case here. And point number 3, the entry setup. That is, how far can price still move against the current market direction or against our bias, and at which reference point on the smaller time frame do we then expect a reaction. This time frame can now be the hourly chart, the 4-hour chart, or even the 50-minute chart, depending on whether we are active as swing traders or day traders. And that brings us to the last and very important point, the trading style. And the question you have to ask yourself is, which trading style suits you? On the one hand, we have the swing trader, and on the other hand, the day trader. The rule of thumb is, the larger the time frame, the easier it is to implement your setup, and the lower the costs and fees. So let's first look at the day trader. We usually choose the 50-minute chart as the entry time frame. In markets where spreads are very low and costs are low, such as perhaps the US indices, you can also find your entry points on the 5-minute charts or even below and trade with a manageable cost structure. You will then end up with about 3, maybe 5 trades per week. Anything above that requires you to really sit down and ask yourself whether all trades actually correspond to your trading plan. If so, congratulations. However, many traders find, or at least I often see, that the most traders who take significantly more trades per week eventually stop keeping a trading journal, and then it becomes difficult to track their setup, improve their setup, and even implement their strategy consistently over the long term. The advantage of day trading is that the profit potential is obviously there, but the margin for error is also higher. If you are currently involved in a trade and suffer loss, for example, and you want to recoup that loss immediately, and it looks as if another setup is presenting itself in the market, you're often inclined to want to recoup that loss immediately, and that can actually lead to you getting caught in a negative spiral and making 3, maybe 4 bad trades in one day that do not correspond to the trading plan at all. And I think most people who have been trading for a long time have probably experienced this. On the other hand, we have the swing trader. Here you usually look for entry points on the daily or 4-hour chart. Perhaps the entry point is then refined again on the hourly chart. However, you may only have 3 to 5 trades per month here, and from this number of trades alone, you can see that it is very manageable to keep a trading journal, track your trades, and really execute every trade according to your plan. Another advantage is that we can also use fundamental analysis tools, which we will discuss later in the series, and use them to our advantage. So in summary, it's simply more likely that you will achieve a higher hit rate and a higher risk-reward ratio here. The next video in the Market Maker Mastery 2025 will be about daily bias. That means how we as day traders determine the direction for the day, but also how we as swing traders can find an entry point. So be sure to subscribe to our channel and activate the bell if you want to dive deeper into the subject now and learn how we translate this concept into trade setups. Click on the link below the video. You'll be taken to a free workshop. There you will also learn how we use our fundamental analysis tools. You can also ask us any questions you may have. We're happy to answer all questions, so click on the link and we'll see you there.